Hi, Mark Ram here. Today I want to talk to you about how you can build a no-lose retirement plan. And basically, we're going to be using life insurance as our primary product. So let's get started just by asking some questions. First, how much time do you have to prepare for retirement? Obviously, the longer the time frame is, the more potential you have to succeed at your retirement goal. Secondly, how much have you already accumulated towards your retirement? Unfortunately, many of us have not put enough away to really see ourselves through what we are going to need when we reach retirement age. And the last question, which is probably the most important, is do you think future tax rates will be higher than today, lower than today, or about the same? So let's move on and see where we are. Well, if you think that your tax rate is going to be lower in the future, take a look at what's happening to our government plans that are out there to protect us and provide some of that retirement money for us. As you can see from this chart, Social Security disability basically is already bankrupt, which means there's not enough money coming in to provide for the benefits that are being paid out. Medicare by 2030 is going to be in the same situation. Not enough money coming in to pay out the benefits that are required. And Social Security about 2035 is going to be, again, in the same position. So what does this mean to most of us? Well, it means that we're either going to have to reduce the payouts that we're making and or increase our taxes to pay out the rates that we are. So we're going to either see increased taxes and decreased payouts, or just increased taxes with the same benefits. So that's what we have to look for in the future. So where can we save for retirement today? Well, we could put money into a bank or credit union, but obviously you've got very low returns. You're making less than 1% on basically all of your returns in these bank or credit union type investments. What about the stock market? Well, here you've got, generally you need to have a fair amount of capital to be able to invest properly. And then you've got market risk. And we've all been through that. And I'm going to show you an example in a little bit of what that market risk looks like and what it can do for you. Third, we could invest in land or real estate. And here again, you've got some problems in that generally you need capital to get started or you need credit. And then you've got a liquidity problem, because if you needed your money quickly out of that investment, it would take time for you to liquidate it, and it may lose money in the meantime as well. Another investment source for retirement, of course, is a business, which a lot of people have started and plan to sell to finance their retirement plan. Here, you're going to need capital, you're going to need credit, and of course, you've got business risk, is in that your business might fail if you, as time goes on, you just don't have any guarantee in that area. And of course, you've got a liquidity problem again. When it comes time to sell, you've got to find the right buyer. And the last place is life insurance. And here you basically have two things working for you. One is you need time to accumulate the money, and you've got to be insurable in order to acquire the policy in the first place. So let's take a look at the next thing, which are taxes. How do taxes affect your money? Well, again, you've got to understand how taxes affect your savings in order to fully utilize the tax laws to protect you and to grow your assets. So if all your money is in savings accounts and CDs, 100% of all of the income in those investments is going to be taxed on an annual basis. So you will lose a portion of your growth every single year. If, on the other hand, you're in a tax-deferred environment like a 401k, an IRA, fixed annuities, or savings bonds, you've got a tax deferral on the front end. That is, you can have some tax advantages when you put the money in, but again, when you pull that money out, it's 100% taxable. The last place is in a tax-exempt vehicle, like a Roth IRA or cash value in a life insurance product. Here you're paying taxes only on your seed money. So you're paying taxes when you put the money in, but it grows tax deferred, and you can access the money tax-free, and it can be passed on to your heirs tax-free. So if in fact you feel that future tax rates are going to be higher than today, it probably makes good sense to look at a tax-exempt vehicle to save for retirement as opposed to one that's going to fully tax you when you start pulling that money out. The next thing I want to look at is what we call the 4 phases of retirement. The 4 phases of retirement are your contribution, your accumulation, your withdrawal, and the transfer of that money when you die. So let's look at IRAs and 401ks. Well, they're tax favored when you put the money in. They grow tax deferred as accumulation. But as I stated before, when you take the money out, it's fully taxed. And when it passes on to your heirs at your death, again, it will be fully taxed. On the other hand, in cash value life insurance plan, you're going to pay taxes on the front end, but it will grow tax deferred. You'll be able to access the money for withdrawal income tax free, and life insurance death benefit is always tax free to the ultimate beneficiaries. So it does make sense if to defer those taxes, and obviously you don't want to pay more in taxes when you retire than you did when you could have while you were putting the money in. So let's look at a universal life insurance. What is it? So this is the product that I generally use. One, of course, it is life insurance protection. It has growth potential because it's invested into a stock market index, although not directly in the index. How these products work is that the insurance companies buy options on an index, S&P 500, the NASDAQ, some foreign indexes. A lot of times you can choose 1 to 5 different choices inside these plans. Again, you're not directly invested in the market. You're tracking an index. So what does that mean? Well, one, you're not in the market. So if the market goes down, they will guarantee that you won't lose any money in that investment. So your guaranteed floor is basically 0. Although there are some products that have a floor of 0.5 to 0.75%, even if the market goes negative. Now, on the top side, you're also going to have a cap, which means they're going to say, we're only going to guarantee you an upside of 12 to 15%. In most policies today, that's pretty much the upside, 12 to 15%. So if the market goes up 12, you will get the full 12% of the market. But if the market goes up 25, you're going to be capped out at 12 to 15%. There is tax-deferred growth because, again, the money is protected inside the policy, and you're going to have tax-free access to this money as you go along. And by the way, this product is not a retirement plan per se as the government deems them, which means you can take this money out before 59 and a half without any kind of a penalty. In fact, you have access to this money all the way along the time that it's been accumulating for you. And you take the money out in 2 ways. One is through withdrawals, which are considered to be the investment that you put in, which of course is tax-free because you've already paid taxes on it. And the second way is through tax-free loans. And of course, a loan, you're borrowing money out of the policy with the intention maybe to pay it back, but again, maybe not. And we'll show you that in a little bit. And of course, when you die, the beneficiaries of a life insurance policy will receive those benefits tax-free. If you're interested in learning more about the Index Universal Life policies and how it works, Patrick Kelly has written an excellent book called The Retirement Miracle, which I would recommend if you're looking for more information on this particular product. So let's look at an example, and this actually is a historical example from 1997 to 2013. And I'm looking at 3 products. I'm looking at a fixed annuity at 3% return. I'm looking at the stock market as it returned over that time period, and I'm looking at an indexed universal life insurance product with a 12% cap and a 0 floor. So what would happen over that time period if you started with $100,000 over from 1997 to 2013, you would have gotten at 3% return $160,471 in return. Now, if you had been in the stock market during that time period, you would have experienced the tech boom in the late 1990s. And in a period of 2 years, your account would have grown to over $150,000. However, the next 3 years saw the stock market drop quite appreciably, so that by the end of that time period, you were actually below your initial $100,000 investment. Over the next 5 years, again, the market went back up, 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 and then we hit the housing crash of 2008. And of course, the market dropped quite a bit that year. And of course, you lost a lot of money and were down probably around $80,000 of your original $100,000. But the last few years have been very good, and you would have returned back to the market, and you would have ended with $161,000, and which is just slightly more than the 3% you would have gotten had you put the money into a fixed annuity. And of course, you had all of the headaches and all of the pain along the way. And in a lot of cases, most of us would have sold out of the market, probably gotten out at that downturn in 2008 and not stayed in. So what would happen if you would put your money in an indexed universal life insurance product with a 12% cap and a zero floor? Well, those first 2 years, you would not have gotten the full market return, but you would have gotten, your 12% returns. And then you've had 3 years of zero return. So you didn't lose the money, but again, you had no money gaining anything inside that policy. Then you had, a number of years of growth. And then when the market went negative in 2008, you had another 0 year. But then we had, a nice upswing in the market, and you went all the way up to $256,479, almost $100,000 more than you would have gained in either one of the other two investments. So let's take a look at a real-life index universal life policy example. This is an illustration for a 40-year-old male in excellent health, putting away $400 a month from age 40 to age 67. So as you can see, this individual is starting out the first year with a death benefit of about $126,000. Now we're adding the growth inside the policy to his death benefit. It's called an increasing death benefit policy. This actually allows us to accumulate more money that we can then borrow, and it allows us to borrow more money as we go on later on down the road here. So as you can see, we stop investing at age 67, and at that point, we can start pulling out of this policy $76,381 tax-free on an annual basis from age 68 to age 90. And at age 90, this person, if he passed away at age 90, would still leave his heirs a death benefit of almost $409,000. Now, in today's, whatever tax bracket you happen to be in, if you can figure out $76,000 tax-free, if you're in a 40% tax bracket, is well over $100,000 of taxable income. It's what you would need to produce if you had money in a 401k plan, for instance. So what happened? Well, we put money away to age 67. We ended up putting in $134,400. We had a surrender value at age 67 of $445,000. We started taking out at age 68 $76,381. We took it out for 23 years. So we took out $1.75 million out of this plan. And if we passed away at age 90, we would have left our heirs almost $409,000. So what does this mean? What can you do? Well, let me run a proposal for you so that you can see what a plan like this can do for you. We can also run different contribution levels so you can see, how much could you actually create as far as a retirement vehicle. And, how you yourself can create your own no-lose retirement plan. All the appointments that I hold are all done at your convenience in your home or office. We do them virtually. So you can find out if a plan like this would make, a difference in your retirement planning. So give me a call or drop me an email at mark@thrivevirtually.com. I'd be happy to get together with you. I look forward to serving you. And if you have questions about this or anything else that you see on my website, please get a hold of me. I'm happy to deal with you as you are ready to make those decisions in your life. Best to you, and look forward to serving you in the future.